Okay, so let's jump right in. If you're a busy professional here in Singapore, you already know you need to be invested in tech. And that, of course, means the Nasdaq 100. It's where all the growth is, right? But let's be real. Between back-to-back meetings, deadlines, and family, who on earth has the time to watch the market like a hawk?
And that brings us to the real question, doesn't it? How can you get access to all those amazing, world-changing companies without the constant stress and heart palpitations that come with every single market dip?
This right here is the classic investor's dilemma. It always feels like you have to make a choice. You can either chase real, meaningful growth, or you can have peace of mind and actually sleep at night. And typically, your choices look something like this. On the one hand, you can just leave your money in a low-yield savings account. Sure, it's safe, it's secure, but it's also barely growing, probably not even keeping up with inflation. Or you go all in on the pure Nasdaq with an ETF like QQQ. The growth potential is huge, but you're also losing sleep every time the market has a bad day. Neither of those options feels great.
It's a really frustrating trade-off to have to make, but what if you didn't have to choose? What if there was actually a way to get the best of both worlds? Well, this is where it gets interesting. There's kind of a hidden gem out there that was designed to solve this exact problem. It's an ETF with the ticker JPEQ, and the best way to think about it is it's the Nasdaq, but with a built-in safety net. So what is it exactly? Well, JPEG is the Irish-domiciled version of a very famous US ETF, and that's a really important detail we'll get to in a minute. But the main thing to know is that it is specifically built to capture that awesome power of the Nasdaq, but with a much, much smoother ride. So how does it actually do that? How does it pull it off? Well, the magic is really in its unique structure. I like to think of it as a machine with two engines working together. Okay, so let's break this down. Engine number one is your growth engine. This is a portfolio of top Nasdaq stocks. Think Apple, Microsoft, all selected by data scientists over at JPMorgan. But then you have engine number two. This is your income and stability engine. And this is where it gets really clever. The fund sells something called call options. Now, you can think of this as kind of like selling an insurance policy on its own stocks. It agrees to give up a little bit of the crazy extreme upside, and in return, it gets paid an immediate cash premium. That cash acts like a shock absorber. In this quote right here, it just nails the strategy perfectly. You are intentionally trading away a little bit of that moonshot potential, those days where the market just explodes upwards, in exchange for getting paid real cash right now. So here's how that safety net actually works in practice. When the market is just kind of flat, treading water, well, that income engine is still chugging along, generating cash for you. And when the market takes a dive, that cash premium that you've been collecting helps to cushion the blow, buffering your portfolio from the full drop. But here's where it gets really important, especially for us here in Singapore. This is the part you really want to pay attention to. It's not just about a smoother ride. It's about being incredibly tax efficient. This little comparison chart says everything. If you, as a Singaporean, buy the US-listed version, JPQ, Uncle Sam is going to take a 30% bite out of your dividends. 30! But with the Irish-domiciled JPQ, thanks to a handy tax treaty, that tax is cut in half, down to just 15%. And on top of that, you completely sidestep the dreaded US estate tax, which can be a huge, nasty surprise for non-US investors. With JPQ, that risk is literally zero.
I mean, just think about that number for a second. 30% of your dividend income just gone before you ever even see it. Over decades of investing, that is a massive drag on your returns.
And then, look at this. Just by choosing the version that's built for us, the Irish-domiciled one, you immediately slash that tax leak in half. That is a huge built-in advantage that you get right from day one. All right, so we've covered the why this is such a smart tool. Now let's talk about the how you can build this into a simple, automated strategy that's absolutely perfect for a busy schedule. Now, for anyone who truly loves the idea of set it and forget it investing, you need to know this ticker, JEQA. This is the accumulating version. What that means is it automatically takes all that income it generates and reinvests it for you to buy more shares. There's no manual work, no extra transaction fees, just pure, beautiful, automated compounding. So here is the entire blueprint. It's honestly this simple. Step 1, pick your broker. Like Interactive Brokers or Tiger. Step 2, set up a recurring investment plan, what we call dollar cost averaging. And step 3, well, that's it. You just let it run. Let the pros at JPMorgan manage the portfolio while you get back to focusing on your career and your life.
So if we boil this all down, what's the big takeaway? Look, JPEG isn't about getting rich overnight. It's about staying in the game without all the stress. You get that essential exposure to the Nasdaq 100, but you get it with lower volatility, a cash buffer, and a tax-efficient structure that is literally built for you.
Which really just leaves us with one final thought. If you could have the growth that you want with the peace of mind that you need, maybe, just maybe, it's time to stop watching the charts all day and finally put your investing on autopilot.